So as many of you have come to know and appreciate our process, we're going to get into our 2024 outlook. So the outlook is really derived from our investment process. I think you all know, right? We build 10 and 20-year forward-looking capital market assumptions. Those really help us drive our long-term allocations where we're positioning portfolios and helping our clients achieve their objectives. As we go through, then our capital markets research team that has done that work, our investment committee that oversees and kind of champions those ultimate conclusions, that builds into our outlook, our themes, or things that we think are going to be driving prices in 2024 and beyond, and then our portfolio positioning in the year to come. So we'll jump straight into it. So first, a little bit in the rearview mirror here. So 2022 coming into 2023, there were three things we were talking about in markets: persistent volatility, moderating inflation, and a bear market bottom. And I guess while we could arbitrate whether markets were volatile or not, certainly middle and the latter themes here were primary drivers in 23. I would say, putting the inflation genie back in the bottle and moderating inflation was one of the primary reasons that, a bear market bottom did occur in October of 2022. And we saw a pretty successful run in 23. Now, remember, when we were writing these, it was in a period of time where a recession in 23 was, by many, a foregone conclusion. It wasn't an if, but a when, right? And so as we were talking about a bear market bottom and positioning portfolios, that was somewhat counter to what the market was discussing at the time. And you'll see some of that, perhaps lessons learned, for those that tried to lean into the idea that recession was inevitable in 23 and they repositioned their portfolios or went to cash. That was a pretty expensive, call it, error for 2023, and one that we would highlight our investment process is not seeking to time or alternate in markets. And so as our gaze now turns to 2024, there's really three things we think are going to be driving markets. First, maybe that first dose of humility. Our annual outlook is entitled Prepare Not Predict, right? So this idea or notion that we can't or shouldn't predict recessions or predict or market time. Rather, we should prepare portfolios what we think is most likely and build resiliency in portfolios for things that, frankly, we have the humility in knowing that we can't perfectly understand all the direction in markets. So that leads to three themes that we think are really going to be driving portfolios in 2024 and beyond. So the first is this idea around what we're calling the messy middle, which is inflation being range bound, call it 2 to 5%. That's obviously well below the inflation levels that we saw in the middle of 22, and a lot of success in reducing inflation. We even saw inflation figures come out, the final inflation figures for 2023 this morning, showing inflation in the threes, depending on whether you're looking at core or headline, but still moderating in a material way. And a range-bound inflation of 2 to 5%, that actually, we believe, gives a lot of headroom for the Fed to potentially lower rates. And we'll talk more about what that means in a moment, both for prices and portfolio positioning and where we're building and allocating portfolios for 24. The second theme, obviously the headliner here, Prepare Not Predict. This obviously gets to some of that almost hubris of 23 and the recession that never came. Though, a recession was a no-show in 23, doesn't mean that the risks are gone for 24. So we think risks remain acute, but market timing, both recessions and markets, is somewhat futile. And so how do we build portfolios to address those? And by the way, as we'll talk about some of the shifts in portfolios, one of the benefits of markets today is that we believe that we can build resiliency for market volatility without materially giving up return potential. That's something that we enjoy today that we could not say a handful of years ago when fixed income returns were materially lower, just given much lower current yields. The third theme that we think is going to be driving markets is we're calling concentrated consequences. So the very narrow leadership here in the United States. And what does that potentially mean to both opportunity and risks? A colleague actually shared with me just recently some of the pretty incredible stats of the Magnificent Seven, right? The 7 securities that have, really propelled the rally in the United States here. That's, Apple, Amazon, Alphabet, Meta, NVIDIA, Tesla, and Microsoft. So those 7 companies their market cap is larger than the combined market cap of France, Japan, China, and the UK combined. That is pretty astounding. We actually looked at the data. That's over 1,100 companies in those countries combined. And just those 7 stocks have a larger market cap than those countries. So pretty incredible times, in some ways unprecedented, and it's creating both fragility in markets and opportunities as we look forward. So what's the punchline on where we're moving asset classes? We'll obviously dive into some of these pieces in greater detail as we go, but we'll give you the punchline of the joke before we give you the lead in. So here we think fixed income in 2024 has a pretty unique opportunity in portfolios, both building resiliency and increasing forward-looking return. Now, that's not all fixed income is not built alike. So there are nuances to that, which we'll go through in just a moment. We do think that, again, that narrow leadership in markets has created opportunity outside of just US tech or even that Magnificent Seven group. Even if we look at the US equity risk premium, right? So the yield of stocks above kind of local government bond markets rates, the United States is 23 of 27, near the bottom from an equity risk premium perspective globally. So we certainly think there is still opportunity here outside of the United States. And then small cap, one that, because of the Mag 7 really last year had underperformed pretty materially. So we'll get into some of the thoughts and rationale and kind of why that positioning, and also the leveling of that positioning. That's an important component of how we think about size and risk management, which we'll talk about more in just a second. So I know we just went through this idea of, prepare, not predict. And again, we're not seeking to time, say, a recession. And we've actually written extensively on this, and you've probably heard this from us in the past. Even if you perfectly timed the economy, you would mistime the market, right? Many think the economy and the market are twins, but I guess in that analogy, they would be more cousins, right? They're related, but they're not perfectly overlapping. And so we want to assign the appropriate weight to this idea of, the waiting for Godot recession of 2023. Has that, kind of risk gone to the wayside, or because it was a no-show in 23, does that just move into 2024? Well, again, not trying to time a recession, but one of the things that the economic backdrop does for us is it helps us set tone or temperature, if you will. What is our willingness or ability to bear relative risk or absolute risks in portfolios? So as we're constructing portfolios, as we're building our outlook, that helps kind of set that measure, but not done in a way where you'd say, yep, recession is coming in March, and so we're going to materially shift portfolios. That's obviously a market timing element that we think neither we nor the marketplace really has skill in doing over time. Nonetheless, we know the question is going to come up. Well, is there going to be a recession? What's the current state of the economy? So here we're going to set the tone and temperature for you all, and then we'll get into our portfolio positioning. So first, let's start with kind of where most economists tripped in 2023. And this is just one of many measures, right? You can talk about the inverted yield curve. You can talk about the, leading economic indicators index. You can talk about a whole host of factors or data that pointed to the fact that there was a likely chance that 2023 would have a recession, or at least economic slowdown. So this is what we're looking at here is the leading economic indicators index, right? With all economic data, you have lagged, so rear view mirror data, coincident data, things that are happening in about real time, and leading data. Now, there's no perfect predictor of things like recessions or markets. If there was, we would just follow that and everyone would time the markets perfectly. But this is one of the more kind of rational and thoughtful and commonly followed views on leading economic concerns. And so when the line is below zero here, in past precedent, you see the higher likelihood of entering a recession or at least economic contraction. Well, here we have this waterfall of a line here, materially falling leading economic indicators into 2023 and then kind of flattening out. Yet here we sit in 2024, and 2023 was a very robust economic year. So what gives? Where's the difference? The difference undoubtedly was in the consumer. The ferocity and amount of spending from consumers that sustained 2023 was really well beyond what most economists or prognosticators would have predicted. And it certainly led to a false positive of recession in 2020 and 2023. Now, again, that doesn't mean that the risk is gone, right? Just because you were a no-show in 2023. This data here is showing us, hey, there's a yellow light. There's concern that we might have economic contraction, though certainly no guarantee. But speaking of the consumer was, again, that bright spot. And when most talk about the resiliency of the economy, just like 2 weeks ago, they're talking about the labor market. Hey, we have low unemployment, strong wage growth. The labor market is really strong. Well, again, when we speak about lagged, coincident, or leading indicators, we want to make sure that we know what we're looking at when we're looking at the data. So first, when we start talking about the economy and the resiliency, again, we get back to employment. And employment is an important part of the economy, but it's also a classically lagged indicator. So it's kind of like driving in the rearview mirror. So when we look at unemployment figures, we can say, hey, in the past, we've had high employment, but it's not particularly predictive going forward. And let me walk you through this chart briefly. So this dotted line at the top here is when the recession referees, if you will, the National Bureau of Economic Research says a recession begins. And then we look at the data of non-farm payrolls, or basically employment, a number of quarters preceding and post. So you can see even 3 quarters, 2 quarters, 1 quarter before a recession, looking at that data, you'd say, hey, the economy looks robust, things look strong, we're off into the races. But just a short period forward, just 1 quarter, that story swings pretty considerably, right? So as we look at things like unemployment, as we look at things like, labor, these are lagged data points. And so they're instructive, right? But they're maybe not predictive. And just for context here, here's where we sit for, average employment rate, 204,000 over the last 3 months. So, still certainly in the green. But when people say, hey, well, the economy is really on strong footing because of labor, we would say, well, maybe let's not drive through the rearview mirror. Let's try to drive through the windshield. So that's where we start to get into trends and trend data. So this is U.S. employment trend data, again, just trying to set pulse on the U.S. economy. Now, this data dates back to 1948 and really looks at, this is the 12-month moving average of U.S. employment over the unemployment rate. So basically, if the line's above 0, we're adding more jobs, we're decreasing the number of jobs. If it's below 0, we're adding jobs. Now, this trend, obviously, as the line peaks above 0 and these gray bars, starts to indicate, hey, there could be weakness in the economy. Again, there's no given statistic to say there would be a perfectly timed recession. So this would be another one of those yellow light figures, right? So we look at all the way to the right here. We're a bit above this 0 line, and that's been instructive in the past, but not perfect, right? We saw that in the Ben Bernanke 2014-15 timeframe, the 1985s, early 60s, where you had some false positives, but nonetheless, if we're setting pulse, what are we looking for? And we're looking, to just trying to set a backdrop and temperature of where the economy is. So again, with this idea of recession is a no-show in 2023, it doesn't mean that those risks aren't acute in 2024. So in an oversimplified framework and kind of that red light, green light, yellow light, right? There are a number of data points that are pointing towards kind of a yellow light or potential economic slowdown, though there's certainly no guarantee. Now, all of that backdrop helps us set stage for what we think is going to be an important conversation and really start to happen in earnest in the fourth quarter around the direction of the Fed and interest rates. Now, many have been talking, especially with the rally in rates that we saw in November and December, around the Fed beginning to cut interest rates. But it's instructive also to figure out, well, what kind of cut, or where are we today at 5.5 on the Fed funds rate? Is that restrictive? Is that accommodative? So what we're looking at here is it's the effective funds rate over time. This is over the last 20 years, minus the Fed's favorite version of inflation, which is the 12-month core PCE inflation data. And so when the line is above 0, the Fed has effectively a restrictive policy. And when it's below 0, they have an accommodative policy. Now, the Marianas Trench, if you will, here, this, kind of all the way on the right here, that's when post-COVID policy, the Fed's at 0 bound interest rates, inflation takes off, they're really behind the 8 ball. And you can see, unintentionally, they became very accommodative. And then the Everest line moving up is obviously inflation falling, from a peak in June of 2022, but also the Fed chasing its tail and raising interest rates pretty materially. But you see where we are today with a real effective, Fed funds rate, in the 3s. right? And that has continued to grow, even though the Fed has paused since July, because inflation has continued to moderate. So dating back over time, right, the average real effective funds rate is about 1%, or even over the last 20 years, is about 0.5%. So that really leaves quite a bit of room for the Fed to potentially ease. Now, the scenario in which they ease, that's a little bit more unknown, but there are multiple paths lower, right? You could have this, call it, what's been dubbed immaculate disinflation, where you get inflation moderating, unemployment remaining low, and then you enter into a new, economic growth cycle. That would be the soft landing. In that scenario, the Fed certainly could be moving rates lower and would likely be moving rates lower. If we use kind of history as a precedent in soft landings, and by the way, there are very few, the Fed could be moving by, 50 or 75 basis points lower. Now, if we enter into a recession, right, they often, it's often said the Fed moves rates up on an escalator and down on an elevator. So you could see a much more material move down in rates if we see economic weakness. Now, if this conversation was happening in October or November, we'd probably just stop there and say there are multiple paths lower, period. But November and December happened, and obviously there has been a pivot in expectations from the market towards a far more expectations of falling rates. Now markets expect 5 rate cuts starting as soon as March, and we would just say, don't bet the farm on March. Right? This idea that the market has built this beachhead on March and saying, hey, we want these rate cuts and we want them now. Our first comment would be, if you're looking for the first rate cut, the market did it for the Fed in the fourth quarter, right? The Fed controls the Fed funds rate, not the market. So the 30-year fell, the yield on the 10-year fell. If you got a new mortgage in October versus November or December, those fell, right? That's easing. That is easing policy. And the Fed is very well aware that we're still at full employment, even though that's a lagged data point. So, which means either wages need to decline or productivity needs to rise, or inflation will begin to rise if financial conditions ease. So they are very well aware of that, and they're probably going to stick to this, higher for longer narrative. But it does mean that there's room lower. It just might not come in March. So this kind of give me what I want and give it to me now narrative that's drawn up in the fourth quarter, we give a bit of pause there. So that all said, we're talking about a yellow light on the economy. We're talking about multiple paths lower for the Fed. We just want to talk about what is inevitable, right? We don't know what's going to happen, but we know a recession is always coming. It is an inevitability. It's a natural part of economic growth and contraction. Since 1950, it's happened about every 6.5 years, as have markets pull back, maybe not associated with a recession, but still the average annual intra-year pullback on the S&P is about 10%. So volatility in markets, economic contraction, these are things that we know will happen. And when we read about or have experienced the long-term material benefit of compounding and returns, we hear figures of markets return 7%, 8%, 9%, 10%, these incredible figures that compound capital over time. Those numbers are inclusive of these pullbacks. They're inclusive of recessions, right? They're not achieved because you avoided the recession or timed, and missed the recession. They're inclusive of those. So again, this idea of setting tone and precedent, right? We've built a bit more caution into our portfolios, not from a market timing perspective, but we are never going to be in a position where we'll say, yep, here comes the recession, jump out of the way. All right. So now into portfolio positioning. I also know we've gotten some questions in the queue. We'll continue to hopefully address those as we go. If we can't get to them, one, you can reach out to your consultant if we don't get to it by the end of the call. We'll also have Q&A towards the end. So we'll try to address those acutely if we don't get to them along the way. So into portfolio positioning. Now we'll kind of hit you with the punchline, and then we'll go through some of the remainder here. So as you look at year-over-year shifts in our portfolio allocations, this is the more granular detail across fixed income, global equity, and real assets. Now, I want to make clear, again, this is if you just encapsulate 2023 and then look at 2024, where are we a net buyer or seller? So starting with fixed income, right? As we've talked about, we like kind of high quality, intermediate duration fixed income. We'll give you more detail on that in just a moment. Part of that predicated upon current yields and the opportunity to reduce or build resiliency, reduce risk or build resiliency in portfolios. And part of that predicated on the economic backdrop, which we just mentioned, on multiple paths lower from the Fed. Now, not all fixed income is built alike, right? So we're actually underweight high yield bonds, a position that we were overweight and enjoyed the benefit of in 2023. And we'll get into why we're less interested in that space today. Now, equity, the chart and my comment, I want to make sure to reconcile them because they might be a bit confusing here. So we like small caps here in the US. We like international and emerging markets. We are overweight those spaces. But we are showing on this chart as a down arrow. Well, if we just took our portfolios from 23 and rolled them straight into 2024, the markets have moved, right? And so the markets have built a much larger position in large caps, much larger position in the US as those positions have outperformed. And as we think about risk management and our positioning in portfolios, it's important to recognize our willingness or interest in being overweight those areas. So we still like those areas. Those are areas in which we think have opportunities to succeed, but we want to, as capital allocators, manage risk around that. And there's a great saying, right? It's knowledge is knowing that a pumpkin is a fruit, but wisdom is knowing not to put it in your fruit salad, right? The market is information and knowledge. It's telling us that there is opportunity outside of just US tech, outside of just the United States, right? So that's small cap, that's international, that's other sectors. Wisdom, though, is understanding the difference in the willingness we want to take on the size of that bet, right? So those are spaces we still like, but we're managing risk along the way, as you would expect us to do. So let's punch into some of these. And by the way, just based on time, even though we've expanded our time a bit, we can't get to each of these granular buckets. So we're going to hit the highlights, the one we're making the biggest year-over-year moves. But if you have additional questions or we don't get to it, either put it in the queue or we'll follow up with you after. All right, so let's jump into fixed income. This is probably the area of which, one, we've lived on the soapbox a lot in 2023. If you've tuned into any of our content or conversations, cash versus bonds was the cage match of 2023. 2022, duration became a dirty word, right? Nobody wanted duration because bonds underperformed as rates were going up. Then all of a sudden, cash was yielding something for the first time in almost 2 decades. And so everyone's like, well, I'll just phone it in and go to cash, right? So we've been on the stump trying to talk about bonds versus cash for quite some time. We're not going to repeat all of those. But here we want to highlight some of the opportunity cost, especially in the environment of which we just described on multiple paths lower for rates. So if you look at just different duration profiles and their sensitivity to move in rates. So remember, when interest rates go up, bond prices go down and vice versa. The left side of this graph here, so this is the prototypical interest rates rise by 1%. Clearly, you could see that would negatively affect the 30-year treasury and have some pretty detrimental returns. But given the higher current yield in the fixed income market, it might not be as low of a return as you would expect. So interest rates go up by 100 basis points. The ag is down 1.8. Now, nobody wants to lose money, but 1.8 is something you can limp away from. On the flip side, right? And we think the probability of a lower rate stance, both in the market and by the Fed, is much more probable. You start to see the light blue here and where we think some of these prices can move. And so for intermediate, high quality investment grade fixed income, for just a 100 basis point move and having a double digit or an equity-like return, it's an attractive risk reward. Now, moreover, it's an attractive risk reward for fixed income, period. But it's also an attractive risk reward relative to equities today. So equities, the S&P trading at 19 times. Current earnings forward expectations for 2024 are to grow in the kind of low teens, around 13%, right? So to achieve that level of return with those already high expectations, 5 Fed cuts in markets, that's a hard bar to charge, right? So we think not only fixed income is attractive in a bubble, but it's attractive on a relative basis. And just to give some sense of the coil that's in that spring. So Q4, really end of October, November, and December, There was a shift. There was a shift in conversation from the Treasury. There was a shift in conversation from the Fed, right? In the opening the door to moving rates lower, not just this higher for longer narrative. Well, in Q4, the ag, returned about 6.8%. Cash returned 1.4%. And just for context, not that we're recommending like, hey, go long on the 30-year, but U.S. long gov credit index was up 13.2% in just the fourth quarter alone, right? So that's kind of again, when we talk about cash is kind of good at protecting itself, fixed income is good at protecting the portfolio. That's the type of veracity that we're talking about for some of these allocations. And again, they're attractive individually, but they're also attractive on a relative basis. So year over year, high quality intermediate fixed income is one of our kind of highest conviction moves. Now, not all fixed income is built the same, right? So we talked a little bit about high yield before. So high yield to us, again, we love the spread. We love the opportunity that provides structurally in portfolios. We were overweight in 2023, and frankly, the quality of those businesses are still, fairly strong as you look across, call it long only, cash, bond type high yield. There's differences in loans, et cetera. But just looking at that market. Now today, our forward-looking CMA is higher in 2024 for high yield than it was in 2023. But that is solely, more than 100% of that is predicated on the notion that base rates or treasuries had gone up in yield, but the compensation above and beyond treasuries that you're earning to take on that additional risk is much lower today, not just relative to last year, but even historical averages. So today, 323 basis points, you can see on the right here, that's 3.23% is the additional compensation you earn for taking on non-investment grade credit. So on a 20-year average, that's about 4.75. So clearly you're well below that average. Now the time that we really get kind of frothy at the mouth and interested and wanting to own even more high yield is when spreads are about one standard deviation wide or about 600 or so basis points. And to put some historical context around that, so where spreads are today at 323, the relative return to core bonds is actually it trails by about 2%. So, certainly at today's levels, we're less interested. Now, even if you were just to say, well, it's kind of today's levels to average levels, well, still high yield outperforms by about 1%. So you get something, but not a whole lot relative to the additional credit risk that you're taking. Now, when it starts to get to the levels that we really enjoy, which obviously we're not at today, around 6 or change in spreads, you actually have about a 5.5 excess return over a 3-year forward period. And by the way, all three of these are in a 3-year forward return period. So all else equal, we'd actually expect kind of spreads or credit risk to be higher or more acute in 2023. One, kind of based on the idea that companies are rolling what was cheap debt into expensive debt, so that's more burdensome on the balance sheet. And then operating margins remain under pressure. It's really, faced by higher wages and input costs. And so all of that leads to credit risk being a more acute risk, where it's been a pretty benign risk over the last 2 decades. We want to, frankly, own less of it in the year to come. So shifting gears here into equities, into small caps, right? So 2020, coming into 2023, we were, allocated overweight into small caps. And this is just gives some historical context around, really bear market bottoms, which was one of our 2023 themes, and where markets and especially small caps go. And you can see, on average, a lot of success, the gray lines here, various time periods. In this current, green line way down here in the bottom right, that's where small caps have been bumping around in this cycle. So, our predication on interest in small cap being 1, inexpensive, 2, on an absolute and a relative basis, but there's much more kind of dynamism to that. But their underperformance, or frankly, just lack of performance, has certainly been notable in this recent recovery. So as we talk about, concentrated consequences, fragility and opportunity, within the S&P or within large cap or even large cap tech, small caps is another way to express some of that opportunity. So for example, within small cap versus the S&P 500, if we were just to simply evaluate sector exposure, the S&P today, based on the success of large cap, has had a lot of technology embedded. So now upwards of 30% in technology, whereas you look at small caps is about 15%, right? So owning more of that space provides additional opportunity, for some of these other sectors to add additional leadership. Also, the complexion underneath these hoods is different. So financial services in an environment where the Fed has an opportunity to ease. Remember, tightening is what hurt the banking system. And in March of 2023, we had our, flash in the pan banking crisis and SVB. Easing conditions can also alleviate some of those balance sheet concerns. Most of that acute to called small cap or regional banks. The complexion of that bottom financial services and small cap, there's a lot more there than in large cap. That's the JP Morgans and Citigroups of the world, right? So again, with that backdrop in economic conditions, that can serve for additional movement and leadership. And then back to valuation, because it's something we certainly talked about quite a bit in the years past. If we look at just large cap growth, and I'm picking on that because that is where most of the Magnificent Seven live, it's trading at about 140%, relative to its 20-year price to earnings. So it's trading at 26.5 times versus, on average about 19 times. So certainly trading rich. And by the way, 26 times is a very full valuation, and that's 140% relative to something that's been fairly rich. Small caps by context, small cap core, not growth per se or value, it's trading about at historical averages, call it 22 times, which is very near 20-year historical averages. Now, if you take the bookend of that, you got large growth to small value. And again, we're not recommending a growth or a value under or overweight. Small value trades below historical averages. And if you just look on an absolute basis, it trades at, call it 16 times forward price to earnings, whereas obviously large cap growth is trading at 26 or almost 27 times. The other thing here, though, is as we talk about large cap growth, we talk about the Magnificent Seven. There's so much conversation there, and rightfully so. But we also want to make clear that the Magnificent Seven isn't the only thing in the S&P. It's obviously an important driver just given its weight. But if you look at, the top 10 stocks in the S&P 500, they traded about 27 times. Obviously, the 7 of those are in the Magnificent Seven plus an additional 3. But the rest of the S&P 500 trades at about 17 times, right? So there still is opportunity, right? It just from a valuation perspective, it's certainly being skewed in certain ways. And so as we talk about some of this opportunity of, fragility, consequences for the concentration in indices, this is one of the ways that we would express that. So I know we're getting close to time here and for questions, so we'll wrap quickly and then go to our question queue. So in summary and in very quick fashion, so obviously we talked about kind of the current state of the economy, prepare, not predict. We're not here to predict any kind of economic outcomes. But kind of in the green, yellow, red light framework, it's more of a yellow light for potential concern for economic growth. That leads to 3 primary themes we think are going to be driving prices in 24. So that's the messy middle inflation, again, prepare, not predict, and then concentrated consequences, which we just went over. That leads to portfolio positioning. High quality intermediate fixed income is probably one of the things, not just fixed income, owning more fixed income in aggregate. So if you're a 50-50, own more fixed income than just 50-50, or the complexion of fixed income. So less high yield, more high quality intermediate, and taking advantage of some of that duration. Third, talking about maintaining our overweight to small caps. That's obviously, there's a valuation component there. There's a sector component there. There's the fragility associated with some of the narrowness of large cap indices, especially leading into some of those Magnificent Seven names. So that creates opportunity. We didn't get into it today just for time, but maintaining our overweight to non-US, it's something we've obviously talked about extensively over the past year and years. So if you have additional questions, we're happy to talk about those. And then again, this notion of humility, the idea that 2023 was a foregone conclusion. We knew that we were going to get a recession. Those that tried to time that were certainly paid a heavy price. So recognizing that, it's a bit of a fool's errand and that we can build a resilient portfolio that can address some of these primary and maybe even practical concerns without materially reducing our forward-looking expectations. So why don't I pause there, and we can take a look and see in our question queues if we didn't get to anything. I know we have just a handful of minutes here. So let's see, we had a real asset question come in. So in 2022, broad real assets and REITs rallied. Sorry, I'm reading this on the fly. Yeah, so basically a question around positioning real assets and where they stand in 23 going into 24. So messy middle inflation actually, I think, is a great environment for real assets. So why do we call it the messy middle? Because it's not the perfect decline to 2%. Even let's think about just lifetime, right? You have naval activity around the Suez Canal and the Straits of Hormuz. You have, potential concerns for supplies. You have even today, we saw a bit of a reacceleration in some headline prices, right? In headline inflation. And so we think it's going to be kind of bumpy, right? It's not just going to be a perfect 2%. 2 to 5% is an environment in which real assets can certainly perform well and be additive to portfolios, but especially as we dip to that kind of upper range, right? At some point, we're not just going to have this perfectly falling inflation. We've had, 7 quarters of declining rents, for example. Like eventually that will change as that concern, right? Inflation translates to Fed translates to higher rates can certainly translate to real asset benefit. That was going to serve as a great diversifier in portfolios. So in short, with the level of real assets we have in portfolios today, if inflation rallies and it's above 5%, we're going to under-own real assets. We should own more of them. If inflation perfectly lands at 2 or falls below that, we probably own too much of real assets. As we land in this kind of messy middle, we actually think it's a great diversifier and opportunity to build resiliency in portfolios for the year to come. All right, so let's see. Next question here, supply concerns. Okay, on government debt. Look, government debt and kind of the roughly $2 trillion coming in new issuance, it's an important long-term secular consideration, especially around the level of interest rates. All else equal, higher levels of debt to GDP, higher levels of aggregate debt, higher levels of servicing, meaning the cost to service debt, because you can have a lot of debt, but if it doesn't cost you much, it doesn't matter as much. We're now in an environment where we have a lot of debt, and that debt is more expensive, and we've got a lot of that servicing needs coming in. That does and can create interest rate volatility. It is something that, frankly, the Treasury has been, I don't want to say acute in how they're managing that. Towards year end, they actually issued Treasury bills as opposed to Treasury notes or longer dated paper. That created scarcity in the long end of the curve, and that's part of where the reason you saw some of that rally. But the willingness for the market to digest a lot of that paper is going to be based on partially, our ability to tame and contain inflation. Our view is that inflation is more contained, and that this interest in having high quality duration will certainly be sopped up by kind of net buyers, whether that's government paper or otherwise. So it does create an environment where we think, yeah, the federal government has some work to do on deficits, but it doesn't create kind of this acute or primary issue in just 2024 alone. Let's see other questions, and I'm sorry that I'm scrolling these live time here. Let's see. So we got a question. Let's see, non-US equity for 24, focus more on developed or emerging or vice versa, and the logic behind that decision. So as we think about international positioning and really our global allocation, right? The world is our oyster. Rarely would there be an environment in which we're own in total more EM than we own in international, right? Just based on the global market cap. Our forward-looking market assumptions, right? We have a higher expected return from emerging markets, but we also have a materially higher expected volatility associated with those areas of the world, partly because some of the acute geopolitical risks, things like, say, US-China, obviously the issues in the Middle East, those are acute to those regions. And obviously China has been very underwhelming in the short term. Now, nonetheless, though, we think from a relative valuation and opportunity set, Both of those are still quite compelling, but just the question is the size, which is, what we went into previously on how do we kind of build those relative sizing and positions. But both of those markets we think still remain very attractive, especially over a longer time horizon. We're up on time here. I just want to see if we can get to these last couple of questions. Okay, this may be a good one to end on just kind of time period. So, what period of time are equity valuations somewhat predictive? So equity valuations in the short term almost don't matter. Like tomorrow, next week, next quarter, they're not really predictive at all. Over the long term, say a horizon of 5 years or more, when you get into the kind of 7-10 year time frame, that's where you actually start to get some of that kind of magic sauce, if you will, around the predictability of valuations. So valuations are a very poor catalyst in the short term. They're a very good place to take risk and capital over the long term. And it gets back to a lot of what we do and why we do it. In the short term, we think you can easily get caught on the treadmill of trying to trade, today's inflation print, or 2 weeks ago, the wage inflation numbers. That is not a sustainable or reasonable portfolio construct that we think is manageable over time. But taking the majority of our risk on valuation over the long term, frankly, is very predictive to long-term outcomes. And it's a great place to start, but it's not where it ends, right? Just like small caps are cheap relative to large caps, you can't just take that at face value and own only small caps. That's where you get into the practicality, the sizing, the construction, the risk management components. And that's where our capital markets research team and our investment committee play a very heavy role in making sure we manage those on a relative basis. All right, I see we've got even more questions coming in, and I apologize that we're at time. So we'll do this. If we didn't address your question structurally throughout or at the end, feel free to reach out to your consultant. Feel free to reach out to us in aggregate, or I'm happy to get on the line to talk through 2024 positioning or beyond. So if you have any additional questions, always feel free to reach out. We thank you for spending the time with us. We appreciate, time is scarce. And honestly, normally we try to keep it to 30 minutes. So, we've bumped up a little bit here. And frankly, by the number of questions coming in, it seems like we could have even gone longer. So appreciate everyone's time and joining. And again, if you have follow-on questions, always feel free to reach out. So thanks, everyone, and have a great day.